Good afternoon. On behalf of Marsh's US and Canadian Energy and Power teams and Wood Mackenzie, it is my pleasure to welcome the over 200 people who have joined today's webinar, Why Insurers Care About Your ESG Story. My name is Joanne Silberberg. I'm Marsh's Renewable Energy Leader in Canada, and I'll be the moderator for today's discussion. While environmental, social and governance factors have been top of mind for the investment community for some time, the insurance industry is catching up fast. In the past couple of years, we have seen a number of global insurers take a public position in respect to reducing capital allocation for carbon-intensive industries, and in some cases, total withdrawal of capacity for some subsectors. Most recently in June, we saw the United Nations officially release version 1.0 of the Principles for Sustainable Insurance, a guide for managing environmental, social and governance risks in non-life insurance business. The principles include a list of possible actions, provide common aspirations and a global framework for the insurance industry to manage ESG issues. It will be interesting to see if this starts to bring any form of consistency to the varied and somewhat ad hoc approach we've seen to date from insurers in respect to their approach to ESG. Today's webinar is going to cover several key areas of focus, including evolving risks resulting from climate change and the energy transition, energy companies' strategic response to those climate pressures, how banks are assessing carbon intensity and climate risk in lending decisions, and how risk managers are responding. Throughout the presentations, you'll hear about inconsistencies globally in policy approach, which is translated into very different strategies from European versus North American headquartered corporates, and a consistent key message across the lenders and insurers around proactive engagement in telling your ESG story. Today's presentation is going to take about 30 to 35 minutes, which will be followed by an interactive Q&A panel session. Thank you to all of you that have submitted questions in advance, and we'll do our best to cover off on as many of those as possible. You can also submit questions live by clicking the Q&A button on the Zoom menu. Simply type your question into the open area and click submit. Rest assured, if we don't get through everybody's questions today, we'll take note and circle back to make sure that everybody gets a response to their queries. So before we dive into the presentation, I just want to briefly introduce our esteemed speakers. So starting from Wood Mackenzie, we have Jonathan Saltoon, Head of Markets and Transition from the Energy Transition Practice. Jonathan leads analysis for global energy markets, including power, coal, gas, LNG, renewables and new energies. Joining Jonathan from Wood Mackenzie is Valentina Kretschmar, the Vice President of Global Industry and Corporate Analysis. Valentina spent over 20 years focused on the energy sector and is seen as an expert on energy transition of the oil and gas sector into clean energies. Joining his Wood Mackenzie colleagues on the panel is Chris Harrell, Vice President and Head of America's Downstream Consulting for Wood Mackenzie. His focus is supporting clients' asset transactions through commercial due diligence projects and numerous market studies focused on long-term demand trends, electrification, and the impacts of IMO 2020. From Marsh, we have Ed Nicholson, Managing Director from Marsh's Credit Specialty Practice. He'll provide his unique perspective on the evolution of ESG, particularly in relation to how financial institutions are responding. And finally, Michael Kolodner, Managing Director and Leader of Marsh's US Renewable Industry Practice. Mike brings a unique perspective, having previously been on the underwriting side at Nuclear Electric Insurance Limited and Insurance Manager at Excel Corp. So with that, I'll hand over to Johnny Saltoon, who'll start off our presentation today.
Okay, thanks very much, Joanne, and very pleased to be able to demonstrate what we look at in the energy transition at Wood Mackenzie. I'll just start with a brief introduction, 30 seconds, explaining how we look at the energy transition. We have a decades-long experience in the energy and resources industries across lots of different asset bases, be it oil and gas, metals and mining, the chemicals industries, the renewables industries. And people come to us and ask us about questions affecting the energy transition across all markets, all commodities, all fuels, all technologies, and also all sectors as well. So our team really are trying to ask and answer the questions that people have across all those facets. A classic example would be the electric vehicle space, which is happening so dynamically, but affects all of these little verticals, talking about the raw materials within the batteries for the electric vehicle through to the oil replacement and the fuels displacement in oil and downstream, all the way through to the power side and vehicle to grid management strategies. So we consider the energy transition playing out over all our value chain verticals that we cover. So looking beyond sort of the next 10 to 20 years, we have an assessment of how the energy transition can out over a variety of different scenarios, notwithstanding where we are today in a sort of pre and post COVID-19 environment. You can see sort of on the chart, you could see up to a 5 to 10%, maybe even 15% base year reduction in carbon emissions. This chart's just showing you the, sort of the range of carbon emissions when you consider the energy transition. From our 3-degree view, which is actually our base case, all the way down to a 2-degree view, which is more sort of aligned with Paris compliant. The critical point that people come to us and say is that there's still energy demand left in markets that matter. And that's the critical point. There's still growing demand, and not to the extent that some would suggest, but there's also a lot of impediments in both politics and policies to lead you there. And that creates quite a lot of short-term business inertia that sort of locks in quite a lot of hydrocarbon usage over the next 5 to 10 years. If you then move on to how the composition ranges across the different fuels themselves, you can see the different continued hydrocarbon usage in our base case outlook, all the way through to rapid transition where that diminishes. And a good example of why that might be is if you take the latest recovery pathway from China in its 5-year plan, there's actually been quite a lot of green lighting of once thought abandoned coal plant construction. 150 gigawatts or so of coal plant construction had gone into a deep freeze, if you like, but now it's been greenlit to sort of try and bring back some infrastructure growth that is both low cost but also high carbon. If you move all the way to the 2-degree world, of course, you're then talking about those technologies that really matter. And looking at the sectors is another way of focusing on the energy transition. People come to us and say, look, you know, it's going to be a piece of cake to get there, you know, to whittle away a lot of the emissions. But if you look at road transport, which is electric vehicles, and you look at the power sector, which is renewables plus storage, that's still only 50% of global emissions. You still need vast quantities of deployable technologies that are not yet cost effective, and really just looking at sort of pilot projects in places like steel and refining, food and agriculture, the electrification of the heating industry. And for those, you need large gobs of deployable green hydrogen, carbon capture, direct air capture, heat pumps at huge amounts of scale. And that's, to us, where we find a real sort of breakpoint between sort of a rapid transition and then something that's even 2 degrees or lower. I think the final elephant in the room to suggest is around carbon prices and what level of carbon prices you need to help fund these technologies. And to be frank, they're woefully inadequate. If you look at the Swedish flag to the right-hand side of your screen, you know, you've got plus $120 carbon prices, and lo and behold, you've got a green hydrogen smelting, a green hydrogen project in Sweden that works because of that carbon price. But elsewhere, you know, there's only 6 or 7% of total global carbon emissions covered under a carbon pricing regime of above $40 per million tons of carbon. And that's just not enough to get there. You need it deployed in lots of different industries and in lots of different countries where there's still a large amount of manufacturing and industrial activity. And to our mind, you know, we feel that you know, the kind of a global average carbon price might be in that $100, $110 plus. May you get there? Not likely at the moment. There's a lot of policy influence in the EU, although we've seen some watering down over the last 2 days of some of these recovery pathways under the COVID response channel. In China, it's very mixed, and you know, the infrastructure packages could still rely on quite a lot of high carbon, low cost projects. And the US is, of course, a major question mark. I think we'll have to see what happens in the next 4 months with the upcoming elections. So that's just a whistle-stop tour of how we consider different factors and different scenarios that build into the energy transition. I'm going to pass it over to Vanya to take you through some critical points within some of the industries that we cover as well.
Thank you, Johnny. So from the corporate perspective, if we just move on to the next slide, so the energy transition of the oil and gas sector has been accelerating over the past few years, really without losing its momentum through the current crisis. Now, one of the key drivers of the energy transition, in addition to the intensifying regulatory and social pressures, especially in Europe, really has been this investor pressure that has been exercised, especially over the majors. And here we see the evolution of this pressure. It has really grown exponentially, and it has been applied not just on the majors and the boards of directors of the kind of large oil and gas producers, but really across a much broader range of companies in the sector. So on the next slide, we see really sort of the response of the sector to these increasing pressures. To begin with the majors group here, there's a huge difference in the strategic response of the European majors and the US majors, and this strategic response has been very different because of the very different pressures that have been exercised on these companies in Europe and the US. And so the majors have committed both in terms of the carbon neutrality, so a commitment to reduce carbon reduction, which we see on the y-axis, and they have also started investing and creating new strategic directions, new businesses which would see increased investment in cleaner energies. NOCs have followed the majors into the sector. Each of these NOCs has got very different motivations, ranging from, again, investor pressure to the likes of Gazprom that is very much looking into the markets. European market is its key export market, and obviously tightening regulation means that Gazprom has to adapt. The final group of companies that we see are E&Ps. We have seen this even before the COVID crisis. They have started increasingly committing to this carbon neutrality, again, sort of under the increasing investor pressure. Now, in terms of the investment that we see on the next slide, please, here we see kind of the investment for the majors group of the last 5 years. The vast majority of growth has happened through M&A, venture capital growth. So here we see approximately around $10 billion of investment has been put into clean technologies by the majors group. This 10 billion also includes organic investment, and compared to how much these companies have spent on their on acquisition of oil and gas resources, and in addition to the development spend on oil and gas, this spend is completely being dwarfed. So 10 billion over the last 5 years is equivalent to Shell's dividend cut recently, for example, just to put it in some sort of perspective. Where have they invested these funds? Well, they have. There's not been kind of really coherent strategy for the majority of the majors, but we are slowly starting to see kind of winning technologies that are emerging in terms of where these companies are focusing on increasingly. And these technologies are, number one is solar, and number two is offshore wind, as you can see here on the chart on the right-hand side. On the next slide, we look into some of the reasons as to why companies could not allocate more capital towards renewables, because you know, just in February this year we had $60 per barrel oil price, where companies were getting easily over 20% return on their oil and gas assets. This is, you know, pre-FID, so yet to be sanctioned assets. However, things have changed dramatically, but in the $60 per barrel environment, as you could see, this was it did not make much sense for oil and gas companies to allocate capital to traditionally much lower return projects such as renewables, which you can see in the one of the yellow columns at the right hand side. You know, they show much lower returns. However, in the $35 per barrel environment, we are we're completely in a different universe, where actually now returns from oil and gas projects and this oil price environment are equivalent to this the long-term, very safe returns that you can get from renewable projects. So really what we're trying to say is that the attractiveness of renewables has improved in the current oil price environment. And just to finish off on the last slide, one of the key points that many of the companies outside of the majors group often point out is that, well, they're not the majors, so they can't really invest in these new businesses. They're very, very different compared to their traditional E&P businesses. So what should they do to adapt? Well, these are the key pillars for any company, and any strategy that has to be put in place really going forward. And one of the key elements one of the key pillars is really strategy for climate-related risk. So regardless of how big or small the company is, they have to take responsibility for their carbon footprint and put in place a viable strategy, climate mitigation strategy. So thank you. That kind of concludes my few thoughts.
Good afternoon, everybody. The first slide here, it sets out what many of us already know relative to what is in play when a bank sits down with a corporate customer. And the point I want to make here is that it really does pay to look behind the scenes, because this is where important external influences come from. And indeed, this is the source of my own perspective as a part of Marsh's Credit Specialties team. Other banks, non-bank financial institutions, insurers, all of these sit behind the scenes and will be facing similar challenges to a corporate's lead banks. So please bear in mind that the points I'm about to make apply both to your own banking partners, but also their credit risk distribution partners, who influence indirectly that boardroom conversation that they're having with you. Now, the following slide, that just requires a brief stop, and it's intended as a reminder of really what the big picture is. And it's an image you've seen 1,000 times, the good old UN and its 17 sustainability goals. It's nevertheless an appropriate reminder as to what is at the source of the challenges many of you are experiencing now, and which will continue to challenge us all in the future. And note the date here, 2015, it's only 5 years ago, a time frame which is made all the more recent by the seismic nature of change that is needed if these goals are going to be attained. Don't be surprised, therefore, if people within banks that you engage with on this topic seem to be searching for their lines. This is a recurring theme, especially with the commercial relationship managers at banks. The script is literally only just being written. And speaking of that, the next slide, it does get a little bit more complicated. But the aim here is to try and simplify whilst also providing you with context. Now today, the focus of this webinar is how banks are assessing carbon intensity and climate risk. So the message here is that you cannot focus on these important considerations in isolation from those very colourful SDGs. Banks and FIs generally, including insurers, have to incorporate the overall requirements of society into their operating model. And that's what's happening. Sustainability and climate have moved from the periphery to centre stage. And that was one of the stated intentions of the United Nations. If you say the words bank and climate, many people will reference almost immediately the Task Force on Climate-Related Financial Disclosures, the TCFD. But you cannot separate this from the rest of the sustainability conversation. And the light blue inputs on the family tree that you can see, the non-carbon concerns on the environmental side, the social issues, and of course governance, are just as important for banks as the climate element. All of that being said, so much of this is influenced by perception, and the following slide just underlines that. There is no doubt that today an observer could be excused for thinking it is indeed all about the E. The climate emergency has certainly grabbed the media's attention. But of note here is that government bodies such as the EU have acknowledged the imbalance in their approach, prompted of course by the emergency presented by climate change. So our view is that we should anticipate a rebalancing, and that is something which may actually come ahead of regulation, probably as a reaction to corporate and public need, which again has been in the media an awful lot in recent weeks. Our sense is that many corporates are actually ahead of the curve in this regard. Now the next slide, this serves as a reminder that all of this subject matter does need to be taken together. And then when you've done that, you run it through the national regulator. the national regulator is the single most important actor that the banks have to deal with, and potentially also one which other FIs and corporates have to square up to. If we take the European Union as example, and I should say that the general consensus seems to be that the EU is the leading source of regulatory progress and clarity on these matters, it's the regulator who is going to determine what levels of carbon intensity are acceptable or not, and what the regulator says the banks must follow in terms of basic entry thresholds as to what can or cannot be treated as sustainable. And in the EU, that's already starting to happen. We had the Green Deal that was published at the end of 2019, and then in March this year, the EU taxonomy came out. And then just last week, the European Banking Authority confirmed its support for the EU's position on sustainable finance. In our opinion, it is therefore extremely likely that this guidance and regulation will be backed up by the introduction of regulatory capital charges linked to sustainability and/or climate risk. However, this is yet to materialize. So the picture is almost complete in terms of what you need to take account of when dealing with the banking market. But there is one very significant extra, as the next slide shows. And that is the simple fact that modeling climate change forces a bank to change. Well, literally just about everything as to what a sustained global temperature change and our reaction to it across all the different sectors, all the different geographies may do. A bank needs to change the measurement of its outlook relative to credit risk from years to decades. And not just one decade, we're talking 2, 3, 4 decades into the future. And then the variables as to potential outcomes, which of course are both myriad and very importantly, without any form of historical precedent. And on top of this, there is no empirical data, and nor will there be in the immediate future. So if you happen to be a pessimist, there are unintended hard landings everywhere. However, remember that the challenges of climate change are not here in isolation. The breadth of the SDGs is perhaps corporate's biggest ally and something that the banks cannot overlook. At the same time, we must remember that the global economy needs to transition. If it doesn't, then the implications across the credit risk landscape would spell doom for many banks. In short, the banks need to support your transition so long as you don't get left behind by your peers or new technology. A summary of the challenges faced by the banks is contained in the following slide. This is an extract from the 2018 Oliver Wyman and Mercer sponsored report to the United Nations Environment Programme Finance Initiative. Now, this report was referenced previously in the small print of the family tree slide, a report which was generated on the back of engagement with 16 of the world's leading banks. So the good news, shown by those red circles on the right-hand side, is that closer engagement with corporate customers is a critical component of what is believed to be the eventual solution to those climate risk challenges that the banks face. Closer engagement with corporates is the only way banks can address that absence of data, the extended time horizons associated with climate risk, and then the uncharted nature of their credit process. All of this in the context of climate risk needing to be overlaid and then stitched into the fabric of their credit analysis. Just to give you a couple of technical examples, in the course of that work that OW did, the modeled outcomes relative to the mining sector reinforced the requirement for a subjective assessment that took into account the attitude of the company's management towards climate change and actions being taken by their customers in response to climate change risk. Similarly, when it came to looking at probability of default calculations, they noted that these are driven, of course, by quantitative inputs such as emissions costs, but also qualitative ones, such as the adaptability of the borrower to a new environment. Note Oliver Wyman's work with these banks has demonstrated that banks can take representative borrower data and then use it to extrapolate in relation to the performance of their wider portfolio in that segment, in that sector. That is good news, particularly if you happen to be that referenced corporate. And I hope a positive note to lead into our concluding slide. So yes, it is tough for the banks, but there's no need for sympathy. Their ongoing ability to meet corporate need lies in closer engagement between the two parties. And the more granular a corporate can get in relation to its sustainability profile, not just at the corporate level, but actually at the individual project or asset level, which of course is where financing is most often requested, the better. This subject and all of its inputs are going to evolve constantly. Undoubtedly, the script says that we're all going to be having to be working harder than ever before in relation to climate change. However, whether you are a bank or a corporate, the script also says that we can each take control of our own destiny, provided that banks and corporates engage at a granular level, something both sides of the equation need. So my advice to all corporates, therefore, would be to make sure that you are leading the way in this regard, such that your company becomes a go-to point of reference for your banks. Thank you very much.
So we're going to shift gears here a little bit. And as my colleague Joe Silverberg shared early on, there's an increasing focus from insurers as well on ESG, and their focus is changing the insurance landscape quite rapidly. As a result, companies operating in or adjacent to carbon-heavy industries face a challenging insurance market for obtaining cost-efficient and sustainable insurance. The UN Environment Programme Sustainable Insurance Initiative that she mentioned is based on 4 key principles: embedding environmental, social, and governance issues in decision-making, working with clients and business partners to raise awareness around ESG issues, manage risk, and develop solutions, as well as working with governments, regulators, and other stakeholders to promote widespread action, while demonstrating accountability and transparency and regularly disclosing public progress and implementation. To help our clients navigate this evolving environment, we've actually developed a white paper to be released later this month, which also highlights 4 key approaches to communicating on ESG with insurance community. First, taking a proactive approach to providing relevant ESG information as part of an underwriting submission, as part of your market presentations, and really anytime you engage with the insurance community. The second is really to highlight diversification of your business model or planned measures to demonstrate a commitment to transitioning to a low carbon economy. Every insured has a different approach, and it's really important to stress how yours is different. Demonstrate a commitment to reducing your own greenhouse gas emissions, as well as those in your supply chain. And finally, not ignoring the social or governance factors in all of this, highlighting positives such as increased Indigenous employment, commitment to health and safety, and plenty of others. Looking at the next slide, we actually offer further guidance in the paper around very specific questions you can ask yourself as you prepare to communicate with the insurance community in each one of these areas. For example, what commitment have you made to reducing the carbon footprint of your operations? How do you monitor health and safety of employees? What portion of your board are independent directors or women and minorities, as well as others? It's really important to think about these things before you're put on the spot. Additionally, I think it's important to point out that while we've spent a lot of time thinking about this from the perspective of the commercial and investor-owned underwriting organizations that are out there and how they're transitioning their risk appetites, what's been unsaid often is the importance of mutual and captive underwriting organizations. In the end, facilitating risk retention and self-insurance solutions for carbon-intensive organizations is something we reasonably expect many of our clients will increasingly need to consider. Thank you.
So thank you to our speakers. Some very insightful comments there. I'm going to kick us off with some questions, and I might start with you, if that's okay. I'd like to sort of pose the question, what commercial risks have ESG pressures created from an infrastructure perspective?
Yeah, so what we're seeing on the infrastructure side, it's really more around the long-term exposure that you have to fuel switching and then the volume impacts. So on the gas side, kind of in the natural gas area, a lot of it is related to things like the heat pumps and the space heating that was alluded to earlier, and will the industry that you're serving start to move away from needing natural gas? I think on the crude and product side, a lot more of it has to do with electrification of transportation. And then, I think we're also starting to see that, some of the long haul pipeline companies are really starting to think about, what's their exposure to carbon, both on the upstream side and the downstream side. So if you did have a carbon tax that came into place, how would that start to change the relative competitiveness of the upstream assets that they're serving and the downstream markets that, that they're also supporting? We've recently seen some of the private equity firms that we do a lot of work with really ask questions around what's the regulatory risk they're taking on. So is that, if there is a significant move on, on certain types of upstream assets, such as, offshore in Gulf of Mexico or oil sands, could there just be regulatory action that just shuts down, production of those assets, and then, takes away the, the earning potential of those assets? Right now, it's really just more of a scenario or kind of a what if, but we think it will start going to valuation here in the next couple of years. But I think it's also important to say that, we're also starting to see some infrastructure operators, they're playing offense. In the gas space, they really are starting to think about how can they support energy transition solutions, things like distributed generation, renewable natural gas and hydrogen, and how can they make those investments. And then in the product space, we've seen a little bit of infrastructure investment supporting kind of biorenewable fuels, but certainly smaller scale than what we've seen on the traditional side. And then I think the last thing I would just say about this is, the role that, that we'll see in in international projects. So there's been lots of interesting initiatives kind of in Latin America that, that we've had some exposure to. And, I think that, on the gas side, things around, pushing toward cleaner, more use of propane in cooking and a move away from coal has a significant impact on local environment as well as emissions globally. And then some of the renewable and kind of e-fuel initiatives we've seen kind of in the Southern Cone, this gives the industry kind of more at-bats, more opportunities to innovate, more opportunities to invest. And I would imagine some of that will start to kind of come back into the Northern American environment, kind of as the policy regime starts to firm up.
Great, thanks. And Valentina, in your opinion, does oil and gas diversification into renewables make sense?
Well, it's a very good question, and a lot of companies, a lot of boards actually question what the European majors are doing. It's a very different business model. It's a very different business altogether. So if you're an oil and gas company, why not stick to what you do best? And I guess the answer to that is really it depends. It depends whether you're a major or you're a smaller E&P. It will be different strategies, different solutions for different companies. I have an acronym. It's called FIT. You have to be fit. So F, you're future-proofing your portfolio. I is for remaining investable, and T is talent, retaining talent and attracting talent, which is increasingly a problem for oil and gas companies. So I guess if you're a major, European major, especially, you're also subject under, to huge pressures. You will be wanting kind of to ensure that you're fit. But if you're a smaller E&P company, then it may not make sense for you to do this. And I think, as I mentioned during my presentation, that kind of the circle of key pillars when you're creating your strategy, it's really the direction of travel there's only one direction of travel on this. The energy transition is just going to intensify, and it's going to accelerate. It may be different, and it is different in different geographical areas. So it's very intensive in Europe, in the UK. It's maybe less intensive in the US, although we are seeing much, much more ESG pressure now being applied. Things may change quite dramatically over the next few months as well, when they kind of governmental pressure, if that changes. So that, considering that pillar, taking responsibility for your carbon footprint and creating a viable carbon mitigation strategy is really, it is a must for all companies. That doesn't mean that they have to transition, that they have to invest in renewables, not at all. There are many other ways and paths which would enable a company to achieve carbon neutrality. So not necessarily sort of going down the European majors route. So you don't have to invest in renewables, but you certainly cannot ignore what's happening, and you cannot ignore carbon mitigation.
Thanks. And changing tack, Mike, one of the questions that we did get in advance, and I think is front of mind for everybody on this call, is, how are insurers actually assessing and pricing ESG related risks for corporates currently?
Yeah, I think it's, we get a lot of questions around pricing, and of course that's, first and foremost in a lot of our clients' minds in terms of how this is going to affect them. And, the reality is, I think it really is more of a question of risk appetite, and that's really the right way to be thinking about a lot of this, and to anticipating how the market is going to respond given your unique exposures. And, certainly as the risk appetite continues to evolve, the market, depending on where you access it and how segmented it can be, particularly in for those that are in the energy space, I think the reality is that we're talking about changing amounts of supply, and so that's a really difficult thing for folks to be going through. But again, it starts with a discussion around risk appetite, and I think the underwriting community is certainly doing their best to communicate clearly, far in advance, what types of risk exposures are ultimately going to complement their overall portfolio of assets. And as long as folks are paying attention to that and thinking about how their own exposures are going to evolve, then you should be in relatively good shape. The other piece here, and I'll just highlight it again, is really how important in this environment taking ownership for the exposures actually becomes. So really understanding your own exposures, and in some sense that may also mean taking ownership for the financing of that, either through mutual or captive organizations. And we continue to see the importance of that.
And you talked about, well, you've got the floor, Mike, you talked about, key questions to ask yourself as you're preparing to speak to insurers. What does a typical ESG statement to insurers look like? Is there some sort of key things insurers are looking for specifically?
Yeah, I think if you keep those questions that we put in mind, those will give you a really good start. I think the way we've structured the white paper is really designed to give you some practical guidance for how you structure that conversation. But to be honest, a lot of companies have been putting out sustainability materials for some time. And I think, as long as you can consider what's unique to your own company and focus on things that are tangible, areas where you can be very specific about what steps are actually being undertaken, highlighting that in those presentations, being conversant in that, and really demonstrating that it's more than just a piece of paper or a glossy pamphlet that's been produced by your company, but that there are actual actions being taken, and that you as a representative of your company speaking to those demonstrates the depth to which those actions have kind of been pushed throughout the organization. So, from a practical standpoint, there's no one way to communicate, but there are some pretty straightforward and simple approaches, and hopefully you're leveraging messaging that's already happening within your own organization.
And final question for you, Mike, before I give you a break. Do we see a difference in lines of insurance, or insurers typically apply a consistent framework from ESG around classes of insurance?
Yeah, I think, the risk appetite question tends to be one, which is ultimately at the corporate level on the underwriting side. So, while I think it can play out differently depending on the size of individual portfolios and the presence that each individual underwriter has in a given segment, generally speaking, this is a uniform issue. If you have those exposures, you have to communicate on them, because ultimately your ability to align with partners who have enough spread of risk to share that cost and ensure that cost in an efficient manner is really going to change, and it's going to impact all lines.
Okay. And a question for you, either Chris or Johnny, I'll let you choose which one of you takes this. Are social issues around diversity, equity and inclusion changing the framework for ESG, do you think? Are we seeing ESG as criteria as static or dynamic?
Chris, do you want to take that one?
Yeah, I think it's, like any kind of framework, I think it is somewhat dynamic. There are certainly principles that will stay in place over time, but the emphasis will certainly change. Certainly as regulatory, conditions change, as the demands on stakeholders change. Certainly you will start to see the details of how are ESG decisions made evolve over time, and certainly with the climate. With the climate change and energy transition, as mentioned a few minutes ago, we don't have a lot of data at this point. So as we start to get data and we start to get feedback on decisions that are made, that will start to change. I mean, it seems like the rational approach would be to start to update your decision-making framework based on that data, both from a, environmental standpoint, a stakeholder standpoint, but also from a financial standpoint as well.
Yeah, Joanne, if I might just add a point to Chris's point as well. I think, one thing to consider, kind of agree with how Ed and Mike have presented it before. At the moment, there's so much focus on E that, S&G will come along at some stage later. We cover the mining industry as well. With vast amounts of mined commodities that actually the miners themselves have attempted to position themselves pretty well for the energy transition, I would say. That, a lot of them have divested in thermal coal, looking at metallurgical coal, and also happen to have lithium and cobalt for electric vehicles and copper for cabling, grid infrastructure, those kinds of aspects. As you move towards a 2-degree world, I think we're sort of totting up the numbers at the moment. You're talking about almost a minimum of $900 billion of capex that's going to be required over the next couple of decades in the mining sector. And that puts an enormous amount of pressure on the mining industry, spending that amount of money, or even sort of going out to investors and saying, look, this is the type of capital investment that we need within the mining space. And the mining, I guess, practices are not really geared up for that at the moment. Obviously there's a focus on environmental, on water management, on recycling and waste management, but there's a big chunk of social and governmental associated with that you may not see as much in the oil and gas industry. I think about how, everyone knows about, the story with artisanal mining in the Democratic Republic of Congo for, effectively what's happened. The world's supply of cobalt, I think 65 to 70% of it comes from one single source, where there's a real problem on child labor and sort of social responsibility on the mining code. And those questions are going to go away. Similarly, I think nickel in Indonesia, processing of chemicals, all consolidated within the Chinese supply chain. So yes, it's got to be dynamic, and I think there's a sub-dynamism within the standards of ESG as well, particularly when you're looking at mining, I would say.
And while you're speaking, Johnny, then, can you take us through where carbon prices need to be to enable the transition and how that might be applied?
Yeah, so I sort of alluded to it at the start. We see that you need really plus $100 per ton to get towards these super compliant targets, and that does depend on industry. I mean, where if you're looking at carbon capture and sequestration, of which there's a lot of action, I guess, in North America, particularly because you have policy support from the 45Q tax component that enables some support behind, I think $40 per ton, $50 per ton. The low carbon fuel standard in California. CCS, it has got a broad range, but I mean, starting at anywhere from 50 to 60 all the way up to over 100 for power. For industrial, it's a bit more than that. The area that we're quite excited about at the moment is the hydrogen space, where there is so much action going into green hydrogen. So effectively, can you use all this excess solar and wind that's being generated but not used to flow through an electrolyzer to create green molecules of hydrogen, and then ship it through existing networks or new networks, because some of the existing networks can blend with natural gas. And that's we saw the other day when the EU released its hydrogen strategy paper, the targets that are being talked about there are pretty impressive. The actual pipeline has grown, almost doubled over the last 5 months, and then doubled again. That needs carbon prices still, but in Europe you have that level of carbon price support, I think. So at the moment it could be up to 100 to be competitive with gas, SMR hydrogen. I think by 2030 it's more in the $40 to $50 range, which is actually sort of where EU carbon prices are as well. But then it's more a question of onward transportation and onward demand specifics. So carbon prices play a role across lots of different industries. And the price is very, variable, but, we use a rule of thumb of around 100 as a global average, even though it has to be applied to lots of different sectors of the economy in lots of different industries.
Great, thank you. Look, we're coming up to end of time. Just a reminder, if anyone does have any questions, submit them through the Q&A. And I haven't seen, I think we've covered most of those that have come in. So just one final question I'm going to ask each member of the panel. You know, we've got a mix of corporates on the phone of all sizes. If you could give one tip on making sure that you position yourself in the best position with ESG becoming more of a focusing concern, what would it be? What would be the one tip you would give our audience? Why don't we start with you, Ed?
Okay, thanks, Jo. So my tip is just get yourself aligned with your bank, your main bank, but don't stop there. You will have built up, or your Treasury Department will have built up relationship with a pool of sort of core panel banks. Get aligned with those guys, but don't stop there. You need to spread the net a little bit wider. You need to understand that those banks may not be your banks for the future. Each bank is completely unique, and the effect that all of this that we've been talking about will have on each bank, no one can actually predict that. So it's almost a point of taking a step back, get close to the people you already have relationships with, but also spread out your network, as it were, because people you don't yet know may be critical for the next few years in terms of your own corporate's evolution. Thank you.
Thanks, Ed. And Mike, from your perspective, your one tip?
Yeah, I would say the most important thing is to really understand and be able to articulate what your organization is actually going through, because while organizations may vary in the level of sophistication and investment in articulating this, every organization is affected, and this is not something that anyone is immune from. So take the time to really understand how your organization is dealing with it.
Valentino.
Yeah, so I would just say absolutely to any board, do not ignore the issue. You just absolutely have to start looking into, you know, what your strategy is, how your business is going to respond, what is the best strategy for your business. This is absolutely going to come your way sooner or later, and it's do not ignore it.
Johnny.
Yeah, I would say, I mean, I'm just looking at it from a sort of slightly different perspective, but there's very much a breadth of range of applications, technology, sector specific elements that will help seed the energy transition at a different pace, perhaps. So, you know, I guess my focus is on the breadth of different types of solutions, different types of capability within your teams. You suddenly see lots of different things springing up that are quite creative and quite different from how you may have appreciated them before. So maybe focusing on the breadth and less so on the depth is sort of something to have in your toolkit and approach energy transition.
And finally, Chris.
Yeah, I think the one thing I would say is have a strategy both at the corporate level, but also kind of at the asset and functional level. You know, kind of like the Cheshire Cat said, it doesn't matter which direction you go if you don't know, you know, which path you take, you don't know what your destination is. So I think having a strategy makes sense. And if the strategy is we're just going to stick to our, you know, that you're going to manage the energy transition, but not really take part in it, that's fine. But have that strategy, because then it makes the decision making of how do you navigate that ESG matrix a lot easier to move through. So I think having a strategy is definitely step one.
Great. Thank you. Some valuable tips and insights from the panel. So thank you to all our panelists and speakers today from Wood Mackenzie and Marsh. We'd like to thank everybody for your attendance and dialing in. If we didn't get to your question, we will get back to you separately. But if you do have additional questions, please email questions@marsh.com or speak with your Marsh representative, and we'll endeavour to get back to you with the response as quickly as possible. We'll send out a replay of this webcast in the next couple of business days, so look out for that. And keep an eye out for our ESG paper that will be released in the next few weeks. Thanks again for joining us, and have a great afternoon, everybody.